Hi, this is James Zhang, and today I'm here with Pat Poling of Mayor Poling, and we're going to be talking about two deals. So, Pat, maybe give us a little bit of an overview of how you took, let's say, a $4 million deal and turned it into a $10 million deal.
You bet. Thanks, James, and appreciate the opportunity to chat with you and your audience. Um, yeah, it's one of the great things you can do inside real estate, right? Is to take advantage of the 1031 section of the tax code and using a very conservative kind of investment strategy, right? We went out, we bought a good, solid asset for around 4 million. Raised the equity to do that. It grew. We sold it for about 7. And then we took those proceeds, which now included some lazy equity that had built up in that original asset, and we turned it into a $10 million asset. And the returns on that $10 million asset are good, conservative, solid returns, but they're actually the returns on that original capital, which is why 1031s can be really valuable, not just from a tax standpoint, but from a growing wealth and growing cash flow standpoint.
So we're going to go into each one of these deals and talk a little bit more about it. So maybe start with the first asset. So you guys are in California, but this asset is here in DFW. So maybe talk about acquiring this asset and sort of what it took to win this deal.
Correct. So this particular property is on the southwest side of DFW, right at the end of the parkway from coming out of Fort Worth. Good, solid market, growing, but more importantly, with growth in front of it. And that's one of the things we really try and focus on is assets that aren't just good today, but they're going to be attractive to somebody 5 or 7 years down the road. This was originally structured as a 7-year hold. Good, solid asset. It had kind of been operated as a C. Not that it was in poor shape. It just was sort of managed that way. We saw a chance to bring it back to life. We put a few dollars in it and repositioned it so it was a solid B in a market that was really lacking any Bs. There were 2 Bs in that sub-market. They were very highly occupied. There was clearly room in the market for another, but obviously, as everybody knows, you can't build Bs, right? That you can't afford to do it.
Yeah, you can't build Bs, you can't build Cs unless you wait a long time. So this was Southwest Fort Worth. You take Chisholm Trail Parkway, and then basically, what would you say, 20 minutes to downtown, 25 minutes to downtown on Chisholm Trail?
Yeah, it was interesting. When we first purchased this asset, you would drive out of Fort Worth and you would drive maybe 10 minutes, and then you'd kind of be out of town. Okay. And then you'd sort of be in the rural area for a little while, and then you'd get down here to Cleburne. Well, by the time we sold it, which was actually just a few years after the hold period started, it almost had filled in.
Oh, wow.
Because all that growth, I mean, that's the whole reason they built that parkway, was to channel the growth on that side of the metroplex.
So do you remember how many units this deal was approximately?
So this was a little one, 86 units.
Okay.
About half of them are flats, you can see in that photo there, and half of them are townhomes. Okay. So an interesting kind of mix. The flats were structured as an all bills paid, which is really interesting because that's kind of a no-no, right? It's like, oh, I don't want to deal with all bills paid, and people want to convert them. It was actually a really favorable position to be in the market because there was demand for that simplified kind of lifestyle of writing one check. We actually moved rents really substantially, in particular on the all bills paid buildings, to the point where we've even looked at other properties and considered, gee, do you move them to all bills paid? Because we've had such success with it there.
Yeah, so you guys bought this property in 2017. You had third-party property management, I'm assuming. So 86 units gave you enough for third-party property management.
Yeah, just barely.
Just barely enough. All right.
That's tough.
Okay. And then I guess on the left-hand side, we see sort of a classic, and then what you guys did once you got in there. So talk about that process. Was there a lot on the exterior, or was it mostly an interior play?
Yeah. So part of what was attractive was the fact that the bones, as everybody loves to say, right? The structure was in really good shape. The roofs were relatively new. I think they were 3 years old when we bought it. All the siding had been converted out to hardy except for one little section, so we did that. It was just a really good property. But as you can see from the left-hand photo there, a little dated. Now, there wasn't any shag carpeting inside, but
Okay.
it's definitely had that kind of feel when you walked in. And so, we said, great, let's give it a nice upgrade. And so, kind of what you see in the marketplace these days, right? Vinyl plank flooring, nice appliance package. We ended up replacing cabinet doors and drawer fronts. We painted the boxes. Just kind of a nice spiff. It's closer to the $10,000 end of that budget than five.
Okay.
Again, these are large units. I think the average square footage overall was just under 1,000.
Oh, wow.
So they're large units. And we set out from the beginning saying, well, let's see what we can get in the way of rent movement. We thought 20% was something in the right neighborhood, and that we'd see that kind of value movement from it. Two things that happened though that didn't really change our strategy, but I think that's what ultimately positioned us for the premature exit that we experienced was we were able to move a lot of rents without making any improvements. There was simply a demand in the marketplace for a well-run, clean property. As you can see there on the left, they were clean units. They weren't in bad shape. And then as we did the improvements, we definitely saw incremental value on top of that, such that we actually kind of slowed down. We ended up only improving about a third of the property, which ended up being really valuable because it left some pretty good value on the table for the next folks that came along behind us.
So so you guys bought the property in 2017, and then I guess 2 years later or so, you started getting calls about selling the property. And were the calls from listing brokers? Were they calls from buyers? What happened there?
Yes. So people actually started pestering us probably in the summer of 18. We'd held it maybe about a year and a half. I think essentially people sort of seeing what we saw a year and a half earlier in terms of the marketplace and where the demand was. I didn't want to have anything to do with it. Bill, deals with that stuff for us. So I said, just no, we don't have time for this conversation. Finally, Bill beat me into submission, I think in like December, and said, just give me a number. So the way we do it is we just grab our original pro forma.
Right.
We look out 3 years and say, okay, what would we sell it for 3 years from now based on what we think we're going to do? Excuse me. If somebody wants to write us that kind of a check, we'll have the conversation. So
Okay.
that's where the number came from. I fully expected people to say, you're nuts, we're not doing that. And instead it was, oh, okay, we could do that. Such that we then decided, instead of just striking a deal with them, that if there was that kind of interest, let's see what the market was going to do. And that's why we ended up going to market with it.
Okay, so you went to market, sort of went through the listing process. Anything that you learned selling this deal, or that has prepared you to sell deals in the future? Anything that people should be aware of that maybe own deals now?
We absolutely learned a lot on this one. Some of it's what I just mentioned, right? That leaving some really good value on the table for the next folks widens the audience. Buying assets in the right kinds of markets so they're going to be positioned well for an exit down the road. When we go out and buy properties, it's quite interesting how many people are so proud that they're in a market that is fully matured and that they've done every improvement you can do.
Right.
Essentially telling me that there's nothing left for me to do except flip coupons.
Yeah.
And there are buyers looking for that, but there's more buyers that want value add, right? We had a great broker represent us here and really enjoyed that experience. and you really have to be actively involved. It's not a here's the keys, you guys go sell it for us and we'll do other things. It really is a process. It's just as much work selling one as it is buying it. And just like buying one, most of that happens after somebody's put a ink signature on a piece of paper.
What do you think? Is there anything you would have changed before you sold this asset? Maybe for next time or the next deal? Anything that stands out or that you can remember?
I don't know that we would have. About 3 or 4 months before we actually sold, right? So around the time we were getting ready to put it on the market, we basically dialed the rent movement back and said,
Mhm.
let's just keep the place occupied.
Sure.
We left some money on the table there. There was definitely some, because I mean we ran basically 100% occupied, except for the turnover between somebody moving in and out. For 3 or 4 months, there could have been a little more movement there, but nobody needs to be greedy at the trough. We were making a really good return on it, and our energies had swung towards the up leg, what we call the second generation asset. Okay, where are we taking our original investment and the gain we're getting out of this? Where are we going to go put it?
So the original equity was roughly 2 million to buy the asset.
Right.
And then now when you go to sell it, so you have about 3.5.
Correct.
And now you go out there and you're looking for a 1031, something to buy. And talk to me about that process. And what did you guys end up finding?
So in some ways, it's identical to all the other acquisitions we do, right? We're still looking for the same basic kind of asset. We're, a solid B in a performing environment, a good market. The pucker factor comes that you've got this timing issue, and it's really not the 180-day close timing, although I guess somebody could maybe have a challenge with that. It's this 45-day identification window. Finding a good quality asset and then getting it lined up so that the timing of the close of the sale allowed for us to know that we had a really good asset in place. That was a challenge. Now, there's lots of good assets out there. It's one of the reasons we really like Texas. There's 11 of the 25 markets in the country that we think are worth investing in are in Texas. The asset we purchased ended up being in Tyler, which is a market we've been wanting to be in for quite some time. We're excited that we're there. So there's a lot of opportunity out there. There's also a lot of people chasing that, right? So, cap rates can get tight, and it can be tempting in a 1031 because, gee, I made so much on the first one, I can overpay a little bit on the next one. I've got some house money to play with. I think that's a trap you could fall into. So we were very rigorous to say, no, this has got to be a good asset that if we didn't do a 1031, we would buy it on its own and it would stand on its own two legs. It's not being propped up because we're bringing extra money to the table.
So do you remember how you found this deal? Was it a listed deal, or did you just sort of hit the off market schedule and go to brokers? Do you remember how you found the deal?
Yeah, so we've rarely found off-market deals, bumping into somebody in a grocery store or dialing for dollars ourselves, right?
Right.
Off-market deals, and I often joke about it, off-market deals are the most marketed properties that exist, right? So, you go to the brokers and you say, hey, listen, this is what we're looking for. These folks that had this property owned a portfolio in Tyler, and we're looking to make some adjustments to it. And we really liked what they were doing in general in Tyler and several of their properties. This one in particular was a good fit for us from that standpoint. A light value add, not a lot of work to do on this one. So, comparing these interiors, for example, to the classic interiors on the first generation asset, really different. So this was a different kind of asset from that standpoint, but a larger property. This is 120 units, so 86 up to 120. Uh, we ended up paying about the same per door as what we sold for, so pretty comparable from that standpoint. The rents were kind of similar, from that standpoint. But the returns, because we're buying $3.5 million of equity with $2 million of real equity,
Right.
and that really gives you a nice bump to those returns.
And so, right now you're at 12% sort of cash on cash on this deal. Anything else? So on that first deal, I'm trying to remember here. So on that first deal, that was just a straight loan assumption with a supplemental that you guys came in, did that deal, and
Yep.
then you sold the deal. And now on the second deal, do you remember how you financed the deal out in Tyler?
Yeah. So this is, I think this is 10 years. I think
Yep.
this is a 10-year note we've got on this. This one's CMBS.
Okay.
I think you've helped us get a little bit of everything in our portfolio.
Yeah. So this one, Fannie and Freddie at the time, if people remember back, so this is sort of third quarter of
Yeah.
2019, and at the time, Fannie and Freddie were sort of hitting the brakes a little bit on lending because they were hitting their caps. So,
Yep.
the government gives them, a certain number of loans and volume that they can do. And at the time they were saying, hey guys, we're putting the brakes and lowering leverage. And so in order to buy this asset, we need to go up to 75%. And so we went out and did a CMBS loan on this property to essentially get the same sort of non-recourse financing that you were looking for
Mhm.
at the leverage and IO that you wanted. And so, especially out in that market. So I guess if anything else on this particular deal that you wanted to mention?
It. So what's great about this whole process is because we're continually selling and then buying the same kind of asset, right? That same vanilla class B light value add. This second gen will be the down leg for an up leg some number of years from now, right? It's the original underwrite for the first generation asset was 7 years because that's what was left on the loan that we assumed. We ended up holding it 27 months,
Okay.
not by design, but because people were going to throw money at us, and we said, okay, our plan on this is to hold this asset 10 years. About half the properties we've ever purchased, we've ended up selling prematurely because there's been market demand and we can make better than our planned return with an earlier exit. And so if that happens, we'll turn this one and we'll do it again. The whole beauty of that is not only are we rolling over that equity, but because we're not having to stop and pay the IRS, we're getting an interest-free loan from the federal government. On this particular property, it's about $600,000.
Wow.
So the IRS gave us 600 grand and said, pay me whenever you want. So someday we'll stop this chain, and yes, we'll have to pay that tax, but we'll have had 5, 10, 15 years use of $600,000 at zero interest.
And
That's a
that's,
pretty good argument.
yeah, that extra 600,000 is generating a cash on cash return to you as well, right?
Yep, it
While it's
is, and
sitting.
it's
Yeah.
growing, right?
Yeah.
It's going to become 900,000 and 1 million, and that's one of the things that we think is so important about people just getting into multifamily, however they can do it, right? Go buy a duplex on your own, invest with us, invest with somebody else. You can't do these kinds of things with your stock portfolio or a bond investment, right? So keep those; those are good investments to have, but get some real estate, right? That's important.
I agree. I agree. So maybe to wrap up, tell people how to reach out to you. And then I also want to touch on, because most of the people that I work with, most of the people who are just starting into multifamily, they are doing it as a syndication deal by deal. So maybe touch on how you guys are a little different. And then if people want to explore that a little bit more with you, they can set up some time to speak with you.
Absolutely. So my contact info is there. We're not terribly creative when it comes to email addresses. So Pat at Mara Polling, you can probably guess what Bill's is, or Lawrence, or anybody else's, right? So feel free to email me, and stop by our website too, marapolling.com. We've got a ton of educational content. So if you're just interested in learning more about how multifamily works, stop by and check it out. We actually just did a big overhaul, so there's a lot of new content on the site. Our primary investment vehicle that we offer folks is the total return fund. So this is a portfolio of assets. The example we just went through is in the fund. And you become a member of the fund as an investor. You participate in all of the assets that are there. But the difference is, unlike an individual syndication, when we come time to sell an asset, we don't just cash out and send you a K-1 and you pay the tax bill. We execute these 1031s and we continue this rollover process. Our fund is structured to actually be able to run 30 years. I don't know that it will run that long, but it's funded and structured as a long-term investment vehicle for folks that are looking to build long-term wealth and get all those tax benefits you can get over a longer period of time. Now, we do individual syndications. We have those in the portfolio as well. And we're actually working on a bit of a hybrid right now. We have a client that needed a 1031, and we are helping them with that. And we are actually investing alongside them with our fund. So the fund is going to be in that transaction, as well as we're assisting this client so they're getting their 1031 needs met. So any of those things strike a bell with anybody, just reach out. I'm more than happy to chat. I'm an accountant, James, you know that. We're not salespeople, right? We don't really know how to sell. We'd probably be better at this business as syndicating if we were good sales folks. But we're happy to answer your questions and help you give some thought to how you might get into this multifamily game.
Well, you're one of the first people that I knew that went through the fund process and sort of ironed out the kinks. And I see a lot of people who have gone through syndication. Now they're starting their fund. So I think you're a couple of years ahead of most people in this regard. So I appreciate everything that you guys have done, and congrats on the success on this one. And I hope people reach out to you shortly. And thank you for joining today.
You're welcome. Thanks for having us, James.
All right. I'll see you.